What happens when something big occurs after you close your books? That is exactly what IND AS 10 addresses. Welcome to this masterclass, friends. Today we have a clear path ahead. We will cover events after the reporting period. We will look at adjusting and non-adjusting events. Then we will explore disclosure rules and the going concern rule. Section 1. Events after reporting period. Let us understand the basic timeline first. This sets the foundation for everything else. The reporting period is simply your financial year. Events after the reporting period are specific occurrences. They can be favorable or unfavorable, and they happen exactly between the period end and the date of approval for issue. We must clearly define the date of approval for issue. For a company, this is the date the board of directors approves the financial statements. Sometimes, shareholders must approve them later, but the standard is very clear here. The board's approval date is the absolute correct date. We do not use the shareholder approval date. Section 2. Understanding adjusting events. Here, we are actively changing the numbers. Let us understand this clearly. The standard identifies two distinct types of events. First, we have adjusting events. These provide evidence of conditions that already existed at the period end. Second, we have non-adjusting events. These indicate conditions that arose only after the period end. Take a moment to absorb this fundamental difference. We will focus on adjusting events first. The standard gives a very clear rule. The company must adjust the amounts recognized in its financial statements. It does this to reflect these specific events. This means you must actively change the numbers in your books. Let us review some examples. A court case settlement confirms a present obligation. The bankruptcy of a customer confirms credit impairment. This simply means the customer cannot pay their debt. The sale of inventories gives evidence about their net realizable value. This refers to their actual selling price in the market. Even the discovery of fraud shows the statements are incorrect. In all these cases, you must adjust your books. Very important point here, friends. IND AS 10 includes a special exception for long-term loans. Imagine a company breaches a material loan provision. The liability becomes payable on demand. But the lender agrees to waive this breach before the approval date. The standard specifically classifies this waiver as an adjusting event. Section 3. Understanding non-adjusting events. Smoothly moving to the second pillar of our standard. Now we look at non-adjusting events. Remember the definition carefully. These events only indicate conditions that arose after the reporting period. The rule here is strict. The company shall not adjust its financial statements for these events. You leave your numbers exactly as they were. Let us look at two clear examples. First, consider a decline in the fair value of investments. Fair value simply means the current market price. This decline reflects new circumstances. It does not reflect old conditions. Second, consider a company declaring dividends after the reporting period. Dividends are profit payouts promised to shareholders. The company does not recognize these as a liability at the period end. No obligation existed at that specific time. Section 4. When to disclose information. We focus on keeping users informed. Now, what does this mean for us? The standard lists specific disclosure requirements. Disclosures are extra explanatory notes added to the accounts. First, the company must disclose the exact date of approval for issue. Users need to know this exact date. Also, the company must update its disclosures. It must do this when it receives new information about existing conditions. We must also discuss material non-adjusting events. Material simply means the information is significant enough to change decisions. If an event is material, keeping it hidden could greatly influence the users. Therefore, the company must disclose the nature of the event. It must also disclose an estimate of the financial impact. The standard provides several examples of these material events. Let us read them clearly. First is a major business combination. This is like a corporate merger. Next is the destruction of a major production plant by a fire. Then we have the announcement of a major restructuring plan. Finally, we have changes in tax rates enacted after the reporting period. Users absolutely need to know about these major events. Section 5. The going concern rule. Very important point here, friends. This is a severe exception. This rule overrides everything else. An entity shall not prepare its financial statements on a going concern basis. Going concern is the assumption that a business will survive and continue operating. You cannot use this basis if management intends to liquidate the entity. You also cannot use it if they intend to cease trading. Take a moment to let that sink in. Look closely at operating results and financial position. A severe deterioration after the reporting period can indicate a massive problem. The management must actively consider if the going concern assumption remains appropriate. If the assumption fails, the company requires a fundamental change. It must change its entire basis of accounting. Section 6. Summary and Wrap-Up. Let us bring all these concepts together now. We have covered adjusting events. We have covered non-adjusting events. We discussed disclosures and the going concern role. So remember, friends, know your event, know your treatment. If this video made IND AS 10 crystal clear for you, give it a thumbs up right now. Share it with your CA friends, your commerce students, your finance colleagues, because good knowledge must travel. And if you want more IND AS standards explained this simply, hit subscribe and turn on the bell icon. We are building this journey together, one standard at a time. See you in the next one.